Welcome. This is the Option IQ two-day training class. My name is Matt Marchbanks, and I'm excited to be with you. Over the next 2 days, I'm going to take you through the Option IQ software. I'm going to teach you how the software works. I'm going to teach you how to be able to go in each day and be able to find trades to place in the live market. I'll also teach you how to monitor those trades daily so that you know when you should be getting out of those trades, depending on a couple different things that might occur. And then I'm also going to teach you how to exit those trades appropriately as well. All right, so to begin with, let me give you just a little analogy to help you understand how Option IQ is going to play into what you're doing through these different classes. So Option IQ is going to be a trading software that you're going to be able to utilize so that you can earn while you learn. While you're going through all these different classes and you're mastering your trading skills, it's going to take you a while to get comfortable with everything and start putting on your own live trades. So prior to that, we wanted to give you the Option IQ software so that you could begin immediately to earn while you're over here learning how to trade on your own. If you remember the old adage, if you give a man a fish, you can feed him for a day. If you teach a man to fish, you can feed him for a lifetime. What we're trying to do is bring both of those things together. We are going to teach you how to trade, or teach you how to fish, so to speak. And while you're learning that, and it's going to take time, it's going to take, a little bit of effort and practice to be able to get good at that craft. But as you're doing that, and prior to being comfortable enough to go out and actually set your own live trades, we're giving you access to a trading software that goes out and identifies the trade for you. It'll go out and find the trade for you automatically. It'll tell you when to get into that trade, and most importantly, it'll also tell you when to get out of that trade. So as long as you go through this two-day class of mine and you learn how to use the software, you're going to be able to go out immediately prior to really understanding all the different facets of trading, and you're going to be able to start trading in the live market with confidence, knowing that you're using a trading software that's going to essentially do most of the work for you. So to begin with, we have a standard legal disclaimer. Now, Option IQ is regulated by the Commodity Futures Trading Commission, known as the CFTC, and with that, we also have oversight through what's called the National Futures Association, or the NFA. Now, both of these regulatory bodies have asked that before we ever start a class, we make sure that everybody understands that trading involves risk, okay? Just because, we've got a system and we're going to tell you what trades to get into doesn't mean these trades don't involve risk. So just want to make sure that everybody's aware of that, just a standard legal disclaimer. A little bit of history on Option IQ. Okay, the Option IQ strategy and technology that we're going to show you today, just to kind of introduce it to you, has over 27 years of research and development behind it. And it also has over 12 years of customer use. So we've had actual customers using this same type of software, these same technologies, for 12 years now here within the U.S. So this system, or this software, has a lot of history behind it. Let me introduce myself as well. I'm going to be presenting to you here for the next couple of days. So I just want to kind of give you my background. I am the Vice President of Sales for Option IQ, so I'm in charge of a lot of the presentations and a lot of the different events that we hold. I do have what's called a Series 3 license. I've also got over 12 years of trading experience using this technology that I'm going to present to you. So I've been doing this and instructing people on this for a long time. Previously, before doing the Option IQ thing, I was actually Vice President of Sales for an introducing brokerage firm that had over $300 million in customer equity that was being traded on the S&P 500. So what I'm going to show you is really exciting. I love this program, and I think each and every one of you are going to benefit greatly through using the Option IQ software. So with that being said, let's get stuck into it. Now, to kind of set up the introduction of Option IQ, what I want to talk about for a minute is the average stock market investor. And I use the word investor purposely. I'm not calling these people traders. I'm calling them investors. Now, the average stock market investor is somebody who basically goes out and what do? They go out and they give their money to a professional, and the professional says, here's what you should put it into, and the people say, okay, go ahead and do it. And the problem with that is they have no real understanding or knowledge of exactly what it is they're doing. So these average stock market investors are typically putting their money into mutual funds, or they're buying stocks and holding on to them for the long term. I call it the buy and hold strategy. But ultimately, they're doing what a professional trader, or I should say a broker, has asked them to do, with no real knowledge of what they're doing. The problem with being the average stock market investor is if you look at the buy and hold strategy, even if you're buying and holding a mutual fund over a long period of time, the concept works the same. This is a stock market chart. This shows the Dow Jones Industrial Average since it started back in 1900 to just recently. And you'll notice that over time, this market has definitely gone up. We can see here where it started, and it's gone clear up to here where it is today. But the point being is if I was of the buy and hold mentality, where I put my money in and I'm buying it and then I'm trying to hold it over a period of time, most of us aren't going to live 114 years. And furthermore, we would have made money with the buy and hold strategy during this period, but here is the point that I want to stress. You'll notice that when the market opened, or when the Dow began back in 1900, it had a little bit of a spike. It looks like in 1906 here. And then it never really did get back to that same level until, or above that level, until about 1920. So you went from 1906 all the way to 1920 without the market really going up and making new highs. We can take another period of time. We saw a big run-up in 1930, and then we all know that the market had a big crash here in the early 30s. But notice that the market never re-hit that same high until about 1956. So you're talking about 26 years, roughly, from the high going down through that valley in the market and then finally reaching a new high. So my point being is, even though the buy and hold strategies do work over time, there's actually something to be said about trading in a different fashion, because for 30 years or 26 years here, there's not a lot going on. You're not making a lot of money on your portfolio. It's probably actually losing money over this period, and you're not even getting back to your new highs for 26 years later. So could you have done other things during that time? Absolutely. And we want to show you some of those additional things that you can do. In fact, if you looked at that chart a moment ago, if I just put my money in back in 1900 and left it until now, and this is a staggering statistic, that represents a compounded annualized growth rate on the Dow Jones of only 4.95%. Now, let me ask everybody, is 4.95% a good rate of return? And I would actually say no. In fact, 4.95% today in this current environment we're in is barely keeping up with inflation. So 4.95% would not be something that I would be satisfied with, and I'm also saying that you shouldn't be satisfied with that as well. So let's talk further about some things we can do. Well, in addition to the buy and hold strategies that most individual investors utilize, there are professional traders that use things like directional trading. And when I say directional trading, instead of buying over here on the left and holding it until it gets up here, these directional traders are actually saying, hey, with the market right here, based on what I'm seeing and the signals and the indicators I'm looking at, the market's going to go down. And I believe it's going to go down enough to make some money. So they take a directional approach, and they can make money on the way down if they pick everything correctly. At the same time, they might think the market's going to go up at this point. And once again, if it goes up and they're positioned correctly in their trades, they can make money during that period. And so on and so forth. So instead of looking at, hey, if I buy low over here and it goes really high and I sell high, yeah, I can make money. but the rate of return that I'm going to make with that kind of a strategy compared to maybe a directional approach where I'm more actively trading the peaks and valleys, I believe is going to give you a better result. Okay? So that's directional trading. Now the problem with directional trading, and you've already been introduced to directional trading, and that is that it's going to take you a while. There's definitely a steep learning curve, but we're here to help you. We're going to teach you all these different classes so that you actually are able to really know how to trade. It also costs money to educate yourself. Thankfully, you guys are already participating in the program. You've realized that education is important, and it's the only way you're really going to learn how to trade on your own. It also costs money due to losses. The good news is, because we're here and we're holding your hand, we're going to help coach you through that period. And also, it's time-consuming to really learn how to do this on your own, and it's difficult to master. So even though there's a lot of barriers here that we're going to overcome and we're going to help you overcome, right now today, you really have only attended one class of ours in the portfolio class, and so now you are going to take things to that next level. And so before you take things to that next level and really start understanding all the different facets that there are in the trading world, we wanted to give you the opportunity to get into the market immediately. Now, we're not going to have you buy and hold because we don't believe that that is a good strategy long term. We're also not going to have you directionally trade simply because of some of the barriers that you still have to take classes to overcome those barriers. But what we are going to tell you is we have a solution for you and something that you can start using right away without any fear, with total confidence in the strategies and the technology that I'm going to show you. Now, here is how it works. If I look at this chart, this is a chart of the Dow Jones Industrial Average. My question for everyone is, where is the Dow going tomorrow? Where is the market going to go tomorrow compared to where it is right now? And ultimately, even though we can look at a lot of technical indicators and we can take some educated guessing, at the end of the day, guess what? Nobody really knows exactly what's going to happen. And so prior to learning how to use indicators and going through all the other stuff that we're going to teach, what I want to show you is how, without knowing where the market's going to go, without even having an educated idea of where it's going to go, how can I trade? And here's how you do it. We have something called non-directional strategies. With our non-directional strategies that I'm going to teach you today, which can be used through the trading software or implemented through the trading software, we're going to tell you that we don't care which way the Dow Jones goes or which way the market in general goes. All we care about is going in and setting our trades, which I'm going to show you how we do that in a minute, and making sure that we manage the risk. As long as we manage the risk, our bottom line will look after itself. So, with our strategies, I don't care, or we don't care as a company, which way the market is going. We can trade these strategies even if the stock market is going up, if it's going down, or even if it's just moving sideways. So let me show you how to do that. To get in and explain that, what I want to talk about are the 3 keys to our trading system. Okay? So the 3 keys, or what we believe to be important to be able to help you trade with this systematic approach, is number 1, high probabilities, number 2, managing risk, and number 3, rate of return. So these are the 3 keys. So let's go in and talk about each one of these key points in more detail. To begin with, how do our trades work? That's what everybody wants to know. How does the software work? What types of trades is it telling us to set? Well, to give you a general concept, and I really want you to understand the concept of what I'm trying to explain here. If you understand this concept and it makes sense to you, I think the rest of it will just kind of fall into place naturally. So here's the concept. Look at this slide. It says, how do our trades work? Now you'll see there is a green line up at the top of the slide, and then there's a green line down at the bottom of the slide. And then it says in the middle, we can make money when the market stays between the lines for a period of time. So the way that our strategy works is we don't care which direction the market's going. I don't care if the market goes up today. I don't care if it goes down. I don't care if it stays right where it's at. What I do care about is that for the period of time that I'm in the trade, the market stays within a certain range. And this is almost completely the opposite of what you're going to be learning as you're learning how to trade directionally. Directionally, you have to be right. You've got to guess the right direction. You've got to get all those pieces correctly. This strategy is almost the reverse of that. It's essentially saying, I don't care if the market goes up today, and I don't care if it goes down, and I don't care if it stays right where it's at. I just want it to stay below this green line at the top of the screen and above this green line at the bottom of the screen. So long as it stays between those two lines, then I'm happy and that my trade is actually doing well. Let me give you an analogy to kind of explain that concept of staying between the lines. The best analogy that I could come up with that I think will make sense to everyone is driving a car. When you drive a car, the whole key to driving and knowing how to drive, besides learning how to brake and follow the signs on the roads and use your blinkers and all that, would be keeping the car between two lines. And so all we're trying to do is we're trying to essentially have the market stay between two lines. Now, the exciting part about this is it's not like a lane on the road. We actually get to determine how wide the lane is. So I get to determine where the top of the lane is and where the bottom lane is. I get to determine how wide it is. All I'm trying to do is just have the stock market stay between those two lines that I have. So again, I get to determine where I want to put those lines. I can make it as wide or as tight as I want. And the concept is, as long as the market trades, up and down, but stays within that range, then our trades are going to be successful. Okay, the next concept I want to talk about is what we actually trade this strategy on. What financial product do we choose to trade this strategy on? Well, the financial product that we've chosen is not stocks, so we'll start there. The reason is because individual stocks in and of themselves are too volatile. They will not consistently stay between those lines. Even if we set the lines really wide, there could be some unpredictable things that happen, and when those things happen, the stocks could trade up or trade down and go outside of those boundaries. If you take any stock, if you know when that stock's having an earnings report, or if the stock has some really good news or bad news come out, or there's some type of an investigation into the company, you know that that stock's price is going to be dramatically affected, and it's either going to go one direction or another, and it's typically going to move very quickly. And the reason is because it's one individual company. So anything good or bad that happens within that company is going to directly affect the price of the stock. And we don't want to be trading this strategy on those stocks when those events occur. So because of that, and to take the guessing out of it, we've decided to completely eliminate trading this strategy on individual stocks. Let me give you an example of an individual stock. This is a chart of Netflix. Everybody knows who Netflix is. And if you look at this chart, you can see that essentially over the last year, Netflix has had a total of 106% total trading range. That's based on any down moves or up moves that the stock's had. It's had a total range that it's moved of 106%. In our opinion, that is way too much. You'll notice that if I had some boundaries set here, it would be very hard to keep this stock price within those boundaries, simply because it decided to run, and it's run a lot. It's doubled in value. So what I want to make sure everybody is aware of is that we are staying away from stocks with this technology, with this software. This software will not teach you how to trade our strategies on individual stocks. Okay? Instead, we trade on something known as an index. You might have also heard the term indices. An index is actually a more stable product than an individual stock. The reason is because an index is made up of a basket full of stocks. So an index is a product where they take a bunch of stocks, put it in a basket, and all the stocks are weighted, price weighted, and essentially the price of the index is based upon whether, the price of each one of those stocks, whether they go up or down each day. So all those prices together equals whether or not that index price goes up or down. When you have a basket full of stocks all together in one index with one price, what happens is there's somewhat of a smoothing effect. For example, if I had 500 companies that were all in one big basket, and those 500 companies, today when they were trading, one of those companies has a really bad announcement. They are going to miss their projected earnings. And so guess what? Because of that information, that one individual stock drops 20% today. Now, because there's 500 stocks that are in that basket, that one out of 500, even though it is moving down, and it's down, pretty significantly, it is not going to have a huge effect on the entire basket because it's based on all of the stock's performance, not just the one. So there's a smoothing effect that comes into play. And what I mean by that is these indexes don't tend to have these huge swings where it's up 110% or it's down 250%. Because it's based on all of those companies together, it kind of becomes more stable than, say, a typical individual stock would be. So, the indexes that I'm talking about and that I'm explaining to you about are indexes like the Dow Jones, which we've talked about already, which represents 30 companies, the NASDAQ, which represents 100 companies, and the NASDAQ 100 actually is what we're talking about there, and then the Standard & Poor's 500, which represents, and this is the one I referenced, 500 companies. So the more companies you can get in an index or in that basket, the chances of that smoothing effect being effective are even greater. So the more companies you have in an index, the better. So the S&P 500 is my favorite index, and the reason why it's my favorite is because it's 500 blue chip companies here within the U.S. These are the best of the best companies, and there's 500 of them. So the chances that all of those companies are going to have a really bad day or year or a really good day or year, it's probably not going to happen with all of them at the same time. And so that's what's going to create that smoothing effect and create more stability in the market for the trades that we're doing. So that's what an index is. The S&P 500 happens to be kind of the benchmark index. It is, it says here, I'll just read these bullet points to you. The S&P 500 or Standard & Poor's is a stock market index of 500 leading companies that are publicly traded in the U.S. stock market. It differs from other U.S. stock market indices such as the Dow Jones Industrial Average and the NASDAQ 100 due to its diverse constituency. And then bullet point 3 says it's one of the most commonly followed equity indices, and many consider it the best representation of the market as well as a bellwether for the U.S. economy. Okay? So, with that being said, we here at Option IQ focus on the S&P 500. When we're placing trades each and every day, we're focusing and placing those trades always on the S&P 500 index. Again, why? Because it is a basket of 500 companies, as it says here, 500 leading companies that are publicly traded in the U.S. stock market. So we want the greatest smoothing effect. We want this market to be as stable as possible. And so we're choosing to go with this larger index that has more companies. Now, indexes are more stable simply because of what I talked about a moment ago, and this is where we're going to place all of the trades. We're going to avoid stocks. We are not going to place this on any individual stocks. Can these strategies that I'm going to teach today, can they be traded on individual stocks? Could you go out and trade them yourself on individual stocks? The answer is yes, you could. However, I would warn you against it. These strategies tend to work best on indexes. Okay? Let me give you an example of this stability that these indexes have. Here is a one-year chart of the S&P 500, and you'll notice that it went up. It went up from here over on the left side all the way up to here. However, during that entire year, it only went up had a trading range of a total of 26%. It was not 105% like we talked about earlier with Netflix. This one was only 26% trading range. Now, if we take this down even on a shorter scale, because a lot of our trades we're going to set between about 30 days to 70 days. Well, if we take this down to a smaller scale, look at this 30-day period of time. Over 30 days, all 500 stocks together in that basket, total trading range during this period of only 2%. So the index went up a total or down a total, up and down a total, of 2% during a 30-day period of time. That's pretty impressive. That's the stability that I'm looking for the types of trades that we're going to teach you how to do. One last point. Instead of trading options on the cash S&P 500 index, we trade options on index futures. So we're trading the S&P index future. Now there's some benefits as to why we're doing this. We could go out and trade this on the cash S&P index. However, we've chosen not to for a couple of key points. Number one, stability. The index future is a very stable product. It's the product that we've been trading for years with our program. So the index future is where we have focused. Number two, probably the most important reason why we're trading the index future is for the 24-hour market. What I mean by the 24-hour market is because we're trading the option contract on a futures index, the futures markets are open essentially 24 hours a day. Every day they close a few minutes after the regular markets close, and they're closed for about 15 minutes, and then they reopen. Really, the only day they're completely closed would be on our Saturday here in the U.S. So it's essentially a 24-hour market. Now, why is that a huge benefit? Let me tell you why. When things happen, because we're in a global economy now, when things happen in other countries within the financial world, that information travels very quickly through the internet, through news agencies, and is disseminated to the population instantly. And so because of that globalization that we're going through right now, we know exactly what's going on in Asia. We know exactly what happened in Europe. We know it instantly. If you stayed up all night and watched the news, listen to one of the financial networks, you'll see that information. You'll listen to that information. So we want to be able to have that information and be able to react on it. If something's going crazy in Europe right now and the markets are selling off, that means that as soon as the U.S. markets open in the morning, they're most likely going to follow suit. So what are we trying to do? We're trying to have a way of preempting the exit. We want to get out of this thing sooner rather than later. So because this is a 24-hour market, we can get out before a lot of people that are in just the regular S&P cash market or cash index would be able to get out. We could be out and done with the trade prior to them even being able to get out of their trade, because they have to wait for the market to open in the morning before they can go in and exit their trades. So again, that's a huge key and component as to why we're doing what we're doing. Number three is liquidity. So this S&P index future is where a lot of institutional money is traded. That means that there is a lot of liquidity. Now, what's liquidity? Again, this is kind of a basic financial concept, but liquidity is the ability to move in and out of the market rapidly. If I'm going to get into a trade, I have to be able to enter that trade. Somebody has to be willing to take the other side of my trade. But most importantly, when I want to get out, I don't ever want to be stuck in a trade. I want to be able to get out and have somebody allow me to get out of that trade. So that is liquidity, the ability to move in and out of the market quickly. And it so happens that this S&P index future has incredible liquidity, and we're able to move in and out of our trades really with no issues. Number 4, the other thing that the S&P Index Future does for us is it gives us more levels to set our trades at. Now, when I say more levels to set our trades, I'm talking about strike prices. There are more available strike prices on the S&P Index Futures contracts than there are on the S&P Cash Index. And so because we could trade either, we're going and trading the future because there's more opportunity. I can actually set my position at a different strike price or different level using the Index Futures contract versus the Cash S&P contract. So that allows me to have what we call better diversification. And I'll get into diversification probably in tomorrow's class. But when we talk about diversification, the key is that we never want to set the same trade level, the same level in our trade. We never want to enter that same level twice. We want to make sure that we're always setting trades at different levels to diversify, to try and diversify our portfolio from risk. And so what I'm going to show you is how you can use those additional strike prices, those better or more levels to trade at, to actually get on more trades by using the S&P Index Future as opposed to the S&P Cash Index. Last but definitely not least, the way that we're trading right now also has favorable tax treatment. If you go to the Internal Revenue Code, section 1256, it actually explains what those favorable tax treatment pieces are. And I'll let you go and look that up. But essentially, when you're trading this style and you're trading the way we trade, you actually are able to get a break on your taxes. Now again, as it says here at the bottom of the screen, Option IQ does not provide tax services or tax advice. So I will ask you to go and consult with an accountant or your tax preparer if you have any questions on this section. But again, that's another favorable piece as to why we're trading the way that we're trading. All right. Now I want to segue into probabilities. Now, earlier we talked about the Option IQ system. One of the 3 keys to the software and the way we've set it up is what's called high probabilities. So what I want to talk about right now is what high probability means in our trades. So if you look at your slide, this shows essentially a lane. So you've got 2 lines, one above and one below, and then you've got the car here in the middle, okay? And what you'll notice is next to it you see 90% probability. And then down in the bottom it says, our technology finds trades that have a 90% or greater probability of staying between our lines for the duration of the trade. Now let me explain what this means. Whenever we set a trade with the software, whenever you set a trade with the software is going to recommend that you set a certain trade, and it's going to have different trades available. We're going to ask you to use what's called the preferred trade of the day. But when you go in and you look at that trade, you will notice that that trade, based on where those boundaries are, has a 90% probability or greater probability that it will stay between your lines. Now, as I mentioned earlier, the whole key, we make money when the market stays between the trade lines. So the whole key is that it stays between those. If I have a 90% or greater probability that it's going to stay between those trade lines, then I have roughly just less than a 10% probability that it won't. So that is what I'm talking about when I'm talking about high probability trades. Our trades have a high probability that they're going to work the way they're supposed to work, that the market's going to stay between those lines and that we're going to finish the trade successfully. Now, let me give you an example of how those probabilities work. This is a real life example from a real trade that we had. So here's the index over that period of time that I showed you earlier. So this is the S&P 500 index over the 30-day period of time. And you'll notice that, as I said earlier, it had a 2% trading range during this period of time. It went up and down a total of 2% over 30 days. So this is all hindsight, and all of us know that hindsight is 20/20. If we didn't know that it was going to go up or down a total of 2%, the question is, what trade would the Option IQ software have recommended for us? What trade would it have said, here's a possible trade for today? Well, let's take a look. Here was the actual trade that was recommended on the software that particular day. And what you'll notice is, going back to the two lines, and I want you to ignore the yellow lines for now, just look at the red lines on this chart. You'll notice the red line on the chart at the top and the red line at the chart on the bottom, that was where we set our boundaries. That's our lane. That's where we want the market to stay between. You'll also notice that the line, the blue line, shows what the market actually did. This is what the S&P index actually did. You'll notice as it went up, came back down, went back up, came down a little bit, and then kind of flattened out. The most important component here is that even though the index only moved a total up and down of 2% over this period of time, you'll notice that our trading system or software recommended a trade that had a 9% trading range. So that lane that we set, where we put our lane, remember we get to choose how wide it is, the lane that we chose had a 9% range. So we were allowing the index to go up and down a total of about 9% on this example. And what happened? In reality, the index only went up a total of about 2%. So this is an example of a successful trade. This essentially shows that we went out, we set the trade, we determined where our boundaries would be, and the market or the index stayed between the boundaries. This is what we want to have happen every time. Okay? So that's an example of those probability factors telling us exactly where to set those lines or where to put our lanes. And it's all based on the probability. So this trade, when we entered it, had less than about a 9.4% risk. And it had greater than a 90% probability of succeeding and the market staying between the lines. With this probability technology, we can go out and look at the software, and the software is going to tell us, based on the probabilities, where we should be setting our trades. Again, we're never taking on more than about a 9.4% probability of risk. We're always entering trades with 9.4% or less risk when we get into them. So that's where we're going to always set those boundaries. So now, if you look at this, this is a chart of a trade from May of this year, and you'll notice that the index moves sideways. So this strategy, does it work well in a sideways moving market? Absolutely. You can see it here. The question is, how does it do in a market that moves up? This trade was July 1st is when this was set, and you could, or actually it ended on July 1st, excuse me, and you can see that the index rallied and it went up in value, and it got close to our trade boundary, the red one on top, but it never did hit it. So even in an up market, we can utilize this same type of technology or strategy. Here's an example of the market index price going down. And again, we had a trade going during this period of time. If you'll look, you can see that the index did go down quite a bit. It dropped about a little more than 100 points during this trade. Now, when the S&P 500 index drops 100 points, that's approximately the equivalent of the Dow Jones moving down about 1,000 points. But that kind of gives you an idea of what kind of a move that is. That's a pretty significant move. When the Dow drops 1,000, people listen, you know, people are made aware that it's moving down. So this is where the S&P went down, about that same type of a percentage. It dropped about 100 points during this trade. But what I want you to pay attention to is the lower boundary. Where did we put that lower line or that lower lane? We moved the lane clear down to 1700. That's where we were told to set that trade initially, and the market never reached it. So again, if the market's moving sideways, we can employ this strategy. If the market's moving up or down, we can also employ this strategy. As I said earlier, we don't care which way the market's going. We can trade if it goes up, down, or sideways. Now, I've talked about a lot of the benefits. I've talked about the probability factor, those high probabilities. The next question is the risk. Do you remember my other key component, the 3 keys to trading? High probability, which we just covered. The second one was, does anybody remember? It was manage the risk. You have to have a system that manages risk. Otherwise, you're going to get yourself in trouble. One bad trade could cause you to lose more than you've made in your good trades if you don't manage it correctly. And so what I want to talk about is what is the risk in our trades? Using the Option IQ software, what type of risk will I be taking on each trade that I enter? This chart kind of explains it. It says what's the risk, and it still has that wide lane where it shows the 2 lines, and then it shows right on those lines the probability of risk. So right now, the Option IQ software rules state the following. If you set a position above the market, set one of those lines, enter one of those trades above the market, we never want to take on more than a 7.4% probability of risk. We want to make sure that in any of the trades that we enter, our probability of losing is never greater than 7.4%. Okay? Now, everybody asks me, why 7.4? What's the 0.4? The 0.4 is because, as we learned in school when we were younger, if it's 7.4, you round down to 7. If it's 7.5, you round it up to 8. So 7.4 is going to be the greatest amount of risk we can take without it going to 8%. So 7.4 is the rule for all the trades we enter above the market price. For all the trades we enter below the market price, the current rule is 9.4%. That means there's a 9.4% probability that the market or the index price could go down enough to go through that line, which would cause us to lose money. Okay, so 9.4% or less is the rule on the bottom. Now, I said the current rule. And the reason why I said the current rule is because currently we're in a market. If you look at the last 5 years, the stock market has been going up. So because it's been going up, we have been taking less risk on the top part of our trade. That's why we have 7.4 on the top and we have 9.4 on the bottom. If we go into a different type of market, it's possible that those rules will adjust and change. And again, it's based upon the type of market environment that we're in. So again, this is what the current rules are right now, and this has actually been the case for the last 5 years. We haven't had much of a change as far as the market direction. So to summarize this slide, essentially what I'm showing you here is that when it comes to risk with the Option IQ trades that the software is going to display for you each day, there is roughly a 9.4% or less risk of the market actually going through your boundaries. There's greater than a 90% probability of the market price actually staying between your boundaries. Okay, so we know we have risk in these trades. So now the question is, how do we manage that risk on a daily basis? Now, question for everybody. Take a look at this slide. Anybody ever heard of rumble strips before? I'm going to tell you just a quick personal story about rumble strips. I was about 21 years old and had my very first job, and as part of the job I was a delivery man, and I was hauling some product down to a company. It was a pretty long drive, about a 2.5-hour drive. I had to leave early in the morning. I had to get up at about 5 a.m. and be on the road by 5:30. So as I'm driving out, I'd been driving for probably an hour to an hour and a half. I started getting a little bit drowsy. And I had a boss that said, you know what, if you get drowsy, pull over, it's okay, you can fall asleep for 10 minutes, 20 minutes, and then jump back on the road. He says, I just don't want you to, getting in trouble and falling asleep at the wheel. So I decided to pull over, and I think I slept for about 15, 20 minutes, but wanted to make sure that I got the delivery done and got back to the office at a good time. So I hurried and woke up and jumped right back on the road. Within about 10 minutes after waking up, I fell asleep at the wheel doing about 75 miles an hour. The problem is I was going over a little pass on a mountain. And this little pass, it was just a one lane, 2 lanes. So my lane going this way and oncoming traffic on the other side of the lane. So what happened is as I fell asleep, I drifted to the left, went across the other lane of traffic, and hit these rumble strips. And as I hit the rumble strips, it immediately woke me up, brought me to a conscious state, and I recognized what was going on. It was very startling. And as I recognized it, I was able to correct the wheel and avoided actually hitting a tree that was just down off the hill. So I went down off an embankment, out into a field, and I ended up actually hitting a branch of the tree, which kind of broke the window. But I was lucky that these rumble strips saved my life. And literally, they saved my life. So rumble strips are near and dear to me, I guess you would say. And because of that experience, as I was thinking about Option IQ and how we, help you manage your risk, this idea of the rumble strips just kind of came to mind. I thought it was a really good analogy. So everybody understands that rumble strips are on the outside of the lane. They're not on the inside. But with Option IQ, we actually put the rumble strips on the inside of our trade's lines or trade boundaries. So the whole idea here is as we're approaching one of these lines, prior to actually going outside of these lines or these boundaries, we are actually going to have an alarm go off in our trades. In fact, we have an alert system set up within the trading software that will alert you when this happens. Essentially what happens is if you get too close to your top boundary where you've entered that trade or your bottom boundary, okay, either side, it's going to alarm you that you are too close to the boundary and you must exit. Now everybody says, well, what is that alarm? What's the number? What's the percentage, so to speak? If you look at the slide here, it says 40% is that alarm level. So remember, when we started out the trade on day one, we're going to have less than a 7.4% chance or risk of the market going up and crossing the top line, and we're going to have 9.4% probability risk or less of the market going down and crossing the bottom line. So we know when we started this trade out, our probabilities were obviously a lot less than 40%. However, once we're in the live trade and the market starts to move, as it starts to get closer to either side, the probability on that side is going to start increasing, while the probability on the other side is going to decrease. In other words, if I'm moving closer to my top line, my probability on that top line is going to go up in value, or percentage is going to climb. At the same time, the probability of me hitting the lower boundary is going to decrease because I'm getting further away from it. So the key here is watch your probability factors daily. And we've set up a system where it'll watch it for you, and if anything happens, it'll send you a text message and tell you to get out. Or it could, we could call you on the phone and tell you that you need to get out. But the point being, if I hit 40% on either side, so it's not going to happen simultaneously, it's going to be one side or the other. When that side hits a 40% probability, that is our alarm that it's time to get out of the trade. Now, another question, why 40%? Well, if you look at the slide, if I'm at 40% here or down here, I still have a 60% roughly probability that I'm not going to cross through the line. However, the odds are slipping out of my favor. And very soon, I'm going to reach, if it continues, I'm going to reach a 50-50 chance, 50% chance I'm going to cross it or stay within. So in our opinion, 40% chance of this thing crossing the boundary versus 60% chance of it not is too akin to gambling. We're too close to the boundary. We're too close to a 50-50 or too close to 50-50 odds. So we're going to exit the trade and be done with it at that point. Okay, managing the trade with P factors. So if you look at this, this next slide, what you're going to see is kind of what I was just describing. So over here on day one, when we set the trade, we want probabilities that are less than or equal to whatever the rule is. Okay? Each day when those probabilities change, they're going to change because the market's either moving closer to the top boundary or closer to the bottom boundary. So each and every day, those probability factors are going to fluctuate. So if the market starts moving closer to the top boundary, my probability factor has increased to 13%. But simultaneously, my bottom P factor on this lower boundary has decreased to only 6%, simply because I'm moving further away from the bottom boundary and closer to the top one. So the probability of me hitting the top one or crossing it has increased. So each and every day, and this might be 10 days later, the market's come all the way down here, but each and every day, our software is actually going to tell you what your probability factors are for both sides of the trade. And it's really simple if you look at it. All you do is look at it and ask yourself a simple question. Has it hit 40 on either side? If the answer is no, you do nothing, because the trade does not have enough risk to be able to want to close it out early. However, if it does hit 40 on either side, as I'm showing here on this example on this slide, then what are we going to want to do? We're going to want to close that trade out and be done with it. And when we close it out, we are going to take some type of a loss, which we'll cover later. Here's an example of an actual trade that was recommended by the software, and you'll notice that when you got in, the market was clear over here where this blue line starts, and during the trade, this one ended up going up enough, and it got close enough to that red boundary. And guess what? We triggered the 40% alarm. Where you see this P, that means probability warning or alert. So that was the day that I'm pointing at right there that it hit the 40% probability. So guess what? We exited immediately. We closed out the trade, and the whole key is we managed our risk. We took a loss, but we managed our risk. If we would have stayed in this trade and continued to let it go higher, we could have lost more money. So the key is that when we hit the 40, we're going to manage the risk immediately. We're going to get out, and we're going to try to keep our losses, limit our losses as much as possible. So that's a good example, and that was this year. That was in July of this year. That's a good example of a trade that hits a 40% probability factor. All right, moving on. This takes me back to the 3 keys to our trading system. Key number 1 was high probability. We talked about that. We talked about the probability factor. We said, or I explained, that all of our trades have greater than a 90% probability that they're going to stay, or that the market price is going to stay between our trade boundaries. Okay? As far as managing risk, I explained that all of our trades have risk. That risk is going to be less than or equal to 7.4 for the top boundary and less than or equal to 9.4 on the bottom boundary. And when I say that risk, I'm talking about the probability that the market price will actually cross the top boundary or actually cross the bottom boundary during the trade. Okay? And the last bullet point I have here is rate of return. Now, I haven't had a chance to explain this yet. I'm going to explain it a little bit later in the slides. But essentially, whenever you take a trade from our software, you need to make sure that you're making a good rate of return, or that you're targeting to make a good rate of return. Otherwise, stay away from the trade. There's no reason taking on risk and entering a trade if you can't get paid, the amount or you can't, receive the amount of profit that you want to receive for the risk that you're taking on. So again, that's the rate of return.